Okay, people, tonight is the night. You're in for a treat because we have two beautiful people. No, I'm not talking about Joseph and myself. We have Anna and Fernando. Some people call them Fernanda. Now, Anna and Fernando, the newlyweds, guys, you got to congratulate them for that. They currently reside in Denver, Colorado. And in 2019, after joining Jake and Gino, Anna and Fernando formed Alfa Peak Capital to grow their wealth and provide opportunities to their investors. Through Jake and Gino, they realized the power of mindset and abundance and have worked tirelessly, yes, they have, to implement this in their everyday lives. Both Anna and Fernando still work as process engineers in the oil and gas industry, leading construction and optimization efforts. Through selective partnerships and trusted investors, Alfa Peak Capital now manages 159 units worth over $22 million across Greensboro, North Carolina, Denver, Colorado, and Sioux Falls, SD, South Dakota. Hey guys, welcome.
Thank you. Thanks for the intro, Nico. It's great to see everybody. A lot of familiar faces and some faces we don't know, but I'm very excited to be here and share what we've learned so far with everybody. So thank you for the invitation to be here.
Yeah, thank you so much.
Great. All right. Anna and Fernando, you could take away, you could share your screen and present your presentation.
Awesome. Yeah, so just gonna click around and fumble here for a moment, but just really thankful for the opportunity to be here and just kind of be presenting about us, about underwriting. Hope we can add value. We've led a handful of these sessions in the past before, and so we'd love to make this as interactive as possible whenever we're talking about underwriting. So I don't know the format you all typically use, but whoever wants, if you have a question, feel free to pop it in the chat, unmute yourselves, go ahead and ask. We can either answer it now or you can hold it and we can answer it at the end. But that's what we love about this, is just make it as interactive as possible, because that's how we learn the most and provide the most value to others. So really appreciate that. Awesome. So we're building off of what Hun put together a month ago here, where he talked about the concept of underwriting and how it's really just putting together all of your assumptions into a pro forma in order to put together what you think is a realistic business plan moving forward. So that way you can make an offer on a building and feel pretty confident about what you're doing. And so, as mentioned, we've got 159 units across 6 different properties, and 4 of those properties are in Denver. So we're going to be specifically talking about the Denver market here today, and how you can win deals in a really, really competitive low cap rate market here.
But I mean, a lot of markets are competitive these days. So we hope that, some of what we talk about can be applicable in your markets. And in fact, it probably can be applicable in your markets because the competitive environment of this business.
So awesome. We are going to be jumping right into it. So this was, the same introduction. Appreciate Nico and Joseph putting that. We'll have our emails at the end as well.
And for anybody that wants to just maybe reach out to us, we have our Calendly at the end of the slides, so we'll have that up. But if you also want to hear more information about our background, we recently recorded a podcast that was just released with Josh and Gino. It's Movers and Shakers podcast, so you can listen to that as well.
Guys, I'm just going to also add, and so when I send a follow-up email, people are going to get this recording. They're going to get your contact information, your website information, but also everybody out there, they host the Underwriting Pod. And I don't know if it's open to everybody, but you guys can talk about that too, because that is phenomenal. They've been doing that for over a year now, where they go through deal analysis and really in-depth underwriting, and it's an awesome thing.
Yeah, thanks for mentioning that, Nico. Yes, we do we don't open it up all the way to the public, but we open it up to like friends of friends and contacts in a multifamily space. So by all means, we'd love to invite anybody that's on this call tonight or anybody that's interested. And yeah, we have bi-weekly calls. That's where we started it with Nico. Nico was one of the first people to underwrite, and we've learned a tremendous amount through doing that. It's just putting in more and more reps, looking at what other people are doing in their markets, because a lot of things are market specific. but sometimes you can implement certain things from people doing those in the market. And you'll be surprised, sometimes property management companies they'll just know what's happening in their market because they have their blinders on. But we've introduced some concepts to our property management companies that have been utilized in some of our other markets, and it's been completely new concepts to them, and they've implemented them successfully. And we've been able to increase NOI on our properties. So it's just interesting how that works.
Yeah.
And like Fernando mentioned, I guess just diving in, Hoon talked about a lot of kind of the main important concepts that go into underwriting, right? And all of the different criteria for underwriting. And we wanted to touch base on some of the ones that we thought were really, really important to expand on when it comes to, I guess, deeper underwriting.
Yeah.
For those last time, as Anna just mentioned, we had Hoon who went over the high level overview and thought process of underwriting. And today will be more macro way of going into deep into the underwriting.
Yeah, absolutely. So since we only do have about half an hour, we weren't planning on opening up the spreadsheet and going through everything, but if anyone does have any questions, we're happy to do so. We do have it available and in the background. But we're going to touch on a handful of subjects that we found were able to give us more of a competitive edge. One is getting the rent comps right, because that's something that's just so difficult between when we started and where we are. Then we'll be talking about debt and how debt is your biggest partner on any deal. We'll touch on some of the income and how, that not just the rent, but some of the other income, how that affects the valuation of your property, how expenses affect the valuation of your property, and then just kind of take a holistic look at where cap rates have quickly been in at least the Denver market and where we pull some of that information. So yeah, just kind of kicking off, when we first started, you're drinking from a fire hose and everyone tells you just put in the reps, and that's what we did. And so when we first started, one of the first tools that we learned about to start looking at rent comps, of course, you've got, Zillow, apartments.com, and a handful of these tools, but, people just say, hey, pop on Rentometer and see what it says. And that's kind of how we started to just get a general idea of, hey, what's going on here. And so, just wanted to point out, if you look at the top left of Rentometer here, you can see the difference between the 25th and the 75th percentile is a $330 spread. And then you got about $170 spread between the 25th and the average, and then the same the other way. But we'll touch on what that means for property valuation here in a moment, but it just shows you that even in a 0.2 mile radius, this is a core area of Denver here, about a 7 or really like a 6-minute drive from downtown. So very close. You have Colfax up here, which is completely renovated in the area, and this is all single bedroom, single bath rentals within 12 months. So just we'll come back to these numbers here, but we're going to compare them to once you really start understanding the market. And when you're looking at a specific property, if I go 1 or 2 blocks in either way, what are people realistically renting for? And what are the companies that I want to work with renting for? So jumping in.
Yeah, this is, again, this is looking at pricing now from a local property management company. This is actually a company that we utilize, but it's one important thing to understand. It's also market specific, property management companies, right? For the most part, there's some companies that operate in a lot of different markets, but a lot of markets will have their own specific property management companies. And there's a large spread between how one company operates to another. There is kind of a competitor property management company to the one we utilize that we're showing here. And their rents that they're renting out for are typically 6% below this company. So this company is very aggressive. They're achieving these rents. They have a 99% occupancy in the market. So that they're very, very good. But the other company has a huge market share as well. So just by looking at the company, you might think, oh, they're really professional, they're on top of their game because they have a huge market share. But you have to understand sometimes I guess, how they're getting those properties, right? So like, let's look at, again, 575 square foot units, 645 and 575. You can see that compared to the Rentometer numbers that Fernando was showing on the previous slide, right? Everything here is 1,400 and above, depending on the month that you rent out in. And in fact, they use a lot of data analytics. And you can see that if you go to their website, depending on the move-in date, that's where the numbers really change. They charge different pricing based on the lease terms and the move-in dates.
Yeah, and yeah, I mean, 1410 is actually an 18-month lease because they don't want another lease coming due next year in September or October. So they're really trying to push it so that they hit, their peak leasing season, right, in more of the summer months. And so they do have very adaptive pricing, and it's very easy, intuitive. Whenever you call them, they pick up the phone right away, whereas the other property management companies tend not to necessarily pick up right away. So it's just, again, night and day, the customer experience that they give, and people are willing to pay for it. So we'll just look at a handful of other rent comps. This one's a more renovated unit. I know we're not clicking through the pictures and everything, but this would all be, relatively standard amenities. We're talking about 10 to 20 unit buildings, because that's really all you find in the core Denver area outside of the A-class buildings. You're not really going to have swimming pools or gyms or anything else. It's just fairly basic. In fact, you probably won't find AC units in most of the units out here. And most of the properties are going to be built between 1880 and 1930, right, in this part of town. So, yep. So here's another property, a little bit cheaper, 1330. Again, that's for an 18-month lease in 1357, low 500 square foot range. And something that was probably renovated 7 to 10 years ago. It has more of that kind of cream beige wall, wood floors, older lighting kits, generally has white appliances. So it gives you kind of a sense. And then, another one that's completely unrenovated here, as you can see, an old building. They did upgrade the ceiling fan here. They put stainless steel appliances on some of it. But then everything else is really quite vintage on this property. I think that one's a 1917 build. And then, just kind of pointing out, the amenities, right? What you get, off-street parking, that's a big one in this part of town. Some storage, typically the basements, they'll convert into some storage. You'll have on-site laundry, and then hardwood floors is an amenity in this one. So, but that's all they have for amenities. Just wanted to point that out. Because you do want to compare like for like whenever you can. But ultimately, what does that do? So everything we're going to be talking about is going to be all based on looking at a 12 unit that's all one bed, one bathroom, is roughly 575 square feet. And that way we just have kind of a basis point on everything to talk about, and look at a lot of, sensitivity around different parameters, including, rent, other income, expenses, debt.
And what we're trying to drive home is just the competitiveness aspect, right? How to be competitive with your underwriting. And so we're trying to present it from the perspective of, these are the levers you have to look at and understand what an effect it has on how much you can offer on the property. And we're saying this because, when we first started underwriting, we spent about 6 months just looking at Denver, building in the broker relationships, not really thinking that we would ever buy anything in Denver, because we thought, oh, this market doesn't make sense. But really understanding it allowed us to start purchasing in Denver and understand that the market actually does make a lot of sense. But again, we were initially being ultra conservative on everything, and you can see just even from this, right, by utilizing all of the numbers that were shown on Rentometer, 25th percentile, average 75th, right, versus the local PM company. You can see that based on a 30% expense ratio, our market being 5 cap, 5% vacancy assumption, you could easily offer 1.9 million on the property and think that you're just being conservative, right? That's your offer, whereas someone else can come in and offer 2.6 million and outbid you. So initially we were like, how are people doing this and why are people doing this? But it's really the understanding of, or I guess it's having the right partners in place, right? Like a local PM company is going to be one of your biggest partners. and then really understanding, and banks, and then really understanding your market and believing in your market.
Yeah. So what, dollar per unit is just the monthly rent, based on those numbers that we were looking at. Number of units is 12. What total is just, 1037 times 12 times 12 months is 149K. And then if you take that 149K, multiply it by 0.7, which is the inverse of the expense ratio, by 0.95, which is the occupancy rate, and then divide by 0.05 for a 20x multiple. That's how we arrived at this valuation number here. It's not a high fidelity number. It's just to really show the impact that, hey, I mean, there's a $400 spread here in rents, right? But that just shows you that if you think you're just pulling up one of these, you got to really put in the reps. You got to do all of the hard work, find your real rent comps, because someone in your market is doing that. And they're glad to pay a higher number for it because the market really does support that. So, that's just a real high level view on how income and how getting the right rent comps can really change your value and your perspective on the property. But as far as future rent growth, we thought that was a great topic to pull. We pulled this from a website called ALN Data. They don't have the greatest data, but they do have some pretty good information. And here they combine Denver and Colorado Springs, which are two completely separate markets, but they both have been on a complete rip. Denver and Colorado Springs typically have very large rent growth in the summer months in the leasing season, and then go really stagnant in the winter months, right? Something that you see in a lot of markets. But during COVID here, it looks like it was flat for about a year and a half, almost 2 years. Well, that's just because that summer leasing season that happened last year really just stayed relatively flat. You saw a little bit of a rent decline in the market. And then starting in about March this year, things just went on a complete rip. And you can see that effective rents have gone up about $160 in the market, which has just been nuts. And we're seeing that, on our day-to-day, whenever we rent something out, we're getting the rent numbers that we were expecting for renovated units, we're now getting for unrenovated units here in Denver. So.
But, to expand just on this slide a little bit, when we first started, and we're still underwriting, our conservative numbers just are flat, 3% rent growth year over year. We're not doing anything crazy in terms of our future projections or assumptions. But for people who are new to underwriting and are just starting out, this is probably a very difficult time to come into multifamily, because you see these type of trends in a lot of markets, maybe not as steep, but there's definitely been, in a lot of markets, a lot of rent increases that are atypical, because we're almost like making up for the last year. And when you're underwriting, you'll probably start seeing on a lot of pro formas that you're getting from brokers, projections that are based on these kind of trends. And it's just something that's a forewarning to be wary of. When a broker is telling you, oh, we've seen this over the last year, like, 10% growth or something. So I'm putting in here 8% of my pro forma and I'm being ultra conservative. I would just caution people against looking at numbers like that and believing that that's true for the future years.
Yeah. And again, if anyone does have any questions or anything, please, feel free to unmute yourself, pop into the chat, and we can go from there. So that was kind of looking at rent. The other one that we wanted to touch on, which is really important to being competitive, is including all of the other bits of other income. So again, right off of one of the property managers' websites, you can see they've got, of course, deposits that are due, pet deposits, pet rent if you're bringing in a pet, and then they're bringing in utility charges, so that's the form of RUBS, right? And then parking, right? So parking is something that people pay for. Again, the PM that we use does use Rhino, which is a alternative to security deposits. Allows you to have less money that people bring up front by just paying a monthly fee to the company that provides the bond. And then typically, because people bring in less money, you can actually charge more move-in fees and the market starts to bear that and accept it more so. So, if you look here at the bottom left, if you take that $75 a month in one bed utility charges for water and gas, multiply that by 12 units, 12 months, that's an additional 10.8K. Parking, let's say assume that this building, it's a hypothetical building, but it has 4 parking spots, and you're getting an additional $75 a month in parking. For those 4 spots, it's $3,600. You've got 3 pets at $30 a piece. That's an extra $1,080. You've got 12 units doing laundry at about $16 a month per unit. That's another $2,300. And then you've got, of your 12 units, let's assume 5 of them move out, and you have new people that move in each time for another $1,500 total there. So all in, that's 19.3K almost. And when you look at that compared to the last slide, the total rental income of $205,000, an additional 19.3 is 9.4% additional income. So you keep wondering, why am I losing out on my offers by 10% or something? This might be a huge piece of it, right? Because again, at that same 30% expense ratio, 5 cap, 5% vacancy, it's an additional 256K of value you can add to that property there. So.
I think there's a question in chat.
Yeah. So Ryan asks, are you using any rules of thumb for other income? We really do break it down like this on all of our underwriting. We look at how much are we actually charging, or how much is that building utilizing in utilities, and therefore is a $75 per month reasonable? And in Denver, that tends to be pretty close to accurate. You're going to be between $57 and $85 is what we've seen. Parking typically is going to be 50 to 150 depending on what part of town. Rent, laundry, app fees, move-in fees. Yeah, so we don't use rules of thumb. We use kind of assumptions on, hey, about a quarter to half of the residents are going to have 1 pet. Almost everybody tends to do laundry in the buildings. You end up having about 45 to 50% of people cycle through. So that's that, 5 out of 12 units.
So they become our rules of thumb, but they're not somebody else's. I guess we would look at, okay, this is what our property manager does in this area, and this area supports those things. If you're in another area that has a huge, large apartment complexes and there's tons of parking, obviously you're not going to charge people for parking.
Yeah.
But you shouldn't discount the other income. So when you're looking at comps in the area, right, when you're looking at Rentometer, for instance, that's only going to show you rental prices, but then you always need to investigate and dig further and go look at the local property management companies' websites and see what other ancillary fees are they putting in there, and what else they're charging for in your market. So when you're first starting to underwrite, and again, it depends on the area of town. We're just strictly talking about poor areas, very walkable areas where people just, instead of even, a lot of people don't own cars, they just bike everywhere because it's, walkable. There's restaurants close to downtown, close to public transport kind of areas.
Yeah, and one of our big renovations on all of our properties is going to be pet wash stations in the basements and bike storage for people, so they have a place to lock them up and have them, because that's what people love out here. So, but yeah, ultimately, Ryan, for your question, like in what we see outside of RUBS on our markets outside of Denver, it tends to be 1.5% to 2.5% of income as other income is what we end up getting. So if that helps, but we like to break it down whenever we're underwriting it in the deal that we're really going to offer on. So cool. So that's
yeah. Sorry, and I was just going to touch, like in some other markets, in South Dakota, our property has garages, right? And then the previous owner never charged back for RUBS, whereas all of the other PMs and all of the other properties charge for RUBS. So again, you have to understand that. And we've also seen people underwriting, putting in that they're going to charge for RUBS, but then when we did a deeper dive with them in their local market, nobody else is. So everybody's including utilities in the rent. So again, this person, by double dipping in the 2 categories, could have potentially overpaid for the property and not gotten the rents. that they thought they would get.
So, awesome. So moving forward, wanted to talk about DSCR. This was a really big learning curve for us initially, because when we first started, we're kind of used to single family where, hey, you can always get 75, 80% LTVs. And regardless if it's really stabilized or not, because your appraisal is really based on, or your property value is just based on appraiser pulling comps. It wasn't this whole notion of a cap rate, which is just an inverted earnings multiple, and really kind of being valued more so as a business. And so with that, when you're buying a destabilized asset or an asset that's not performing to market, to me, those are one and the same. Even if they're at 100% occupancy, if it's 20% or 30% below rent, I mean, who's going to want to move when they're getting such a steal, right? So what we ultimately found, I want to draw your attention to the buckets in orange here. There's a lot of information. That's why we didn't want to bring out the spreadsheets quite as much. But again, we're looking at a 12 unit. Let's assume that it's listed at 230 a unit or 2.76. We know that let's just say for a 575 square foot unit, that it ends up trading kind of closer to 220 a unit. So that's what we put here for the purchase price. Closing costs going to be about 1.5% in our market. Really, we've kind of trended towards 1.15%. Some additional reserves, and then $15K per unit in renovation costs is a very high level underwriting. But the whole purpose of this is if you take, let's assume that the as is rent is $1,000 a month per unit. So that's, the 144K, and they're getting, $7,200 in other income versus the 19.5 that we just proved we should be able to get on this property. They're operating at a 3% vacancy. And then, these are kind of a hybrid of their expenses with mine, because that's what the banks are going to do. The banks are going to take, all right, what are the taxes, the R&M that they're operating at? A lot of times these mom and pops will do a lot of the labor themselves. They don't really pay themselves, so they might have low R&M, might have just a little bit for contract services and G&A. We just put kind of bogus numbers in here to fill it out. But ultimately, when the bank is valuing your property, they're going to take the T3 rent, the T12 other income, and then a hybrid of the T12 expenses plus whatever you can prove to them that you're going to be operating differently with. And that's going to come out to the debt service coverage ratio that the property, or the debt service that the property can really support. So
Fernando, sorry to cut you up. How would you calculate the real estate taxes for those who might not know how to?
Yeah, we'll touch on that one in a second, because that can be a huge item from what we've seen. Yeah, but yeah, so ultimately, if they want to trade and the market believes that this building is worth 2.64 million, well, the bank is only going to give you roughly 1.6 million or so of debt, and everything else you've got to bring as capital to the table. So these are very capital intensive markets. And so instead of being in that 75 to 80% LTV, most deals in Denver actually trade in the 55 to 65% range, right? So pointing that out, it was a huge steep learning curve for us. But you get incredible debt here as well. So yeah, so you have to adjust this LTV until that DSCR comes in place. And then, Anne, do you want to touch on taxes? Or?
Yeah, taxes, we were just going to drive home that the fact that we've underwritten a ton of properties. We've looked at a lot of different properties with a lot of people in their markets. And what we always tell people first and foremost when they start underwriting is call the tax assessor's office and ask them how did they evaluate their taxes and when do they reassess the properties, because every single market can be different. And a lot of times it'll be like county specific, and sometimes it'll be a county and then there's also a city tax. So you just really have to call a tax assessor's office. There's no easier or more straightforward way to say that. And it's usually the fastest conversation you'll have with anybody in multifamily, but the one that's going to be the most bang for your buck. Because if you get your taxes wrong, it'll completely change your entire business plan. And a lot of people, so like, as an example, some counties reassess every year. Other counties reassess every 5 years. So then, if you bought the property and it's in non-reassessment cycle, you might keep your taxes the same for the next 4 years. Like, let's say it got reassessed previous year, but now you're buying it year 2. And now you have an entire runway of no assessment, so you can keep them flat. Whereas others will reassess at sale. So really, you just have to call the tax assessor's office and ask them how they do it.
Yep. Absolutely. I can tell you that in Denver, you take roughly the sales price that tends to track pretty close to the value that the assessors put. Then they put a 7.15% multiple. And then depending specifically on what sub-county within Denver, I don't even know if they're sub-counties or what, but the specific special use district that you're in, it's going to be roughly like a 65 to 72 mill rate, which is just the cents per $100. So you multiply all that together. If anyone has any questions on their specific market, reach out. We'll try to help you figure out what county you're in and then who to call to get that information. The other one we want to talk about, Denver operates at a 25 to 30% expense ratio. If we were buying in Houston, Texas, we'd probably be at a 60 to 65% expense ratio, right? So you really need to hyper focus on your market, build out your team, know your assumptions, because otherwise you're always going to have a dull pencil, and you might eventually get competitive because the market moves, right? But it's more about luck than it is, really sharpening in on your market. So awesome. Cool. So continuing forward, did some case studies earlier to really kind of point out, hey, again, when you're trying to get competitive and get to that last 50, 60K that you keep getting beat on, how do you start getting there? And there's so many little knobs and tweaks and things that you have to really start getting comfortable with. If you're looking at if you're coming into a market and you haven't made those banking relationships yet, if you look at this first table, that second row, and you're assuming that, hey, I'm probably gonna get like a 4% interest rate. Well, that means to hit that 125 DSCR, you need a 55% LTV now. You need to bring an extra 120K of equity versus someone who's seasoned in the market. And so your IRR, you either accept a lower IRR, or to get the same IRR that a seasoned investor in that market is getting, you need to drop your price by $59,000, right? So again, it's all these little pieces that start making a difference. 59,000 maybe doesn't sound like a whole much, but that you're 2% off on the purchase price now, right? Compared to your competitors, versus that 3.35%, which is all the numbers we had on that last slide, 59.5 DSCR, they're bringing 1.311. And so they can, look at that 2.64 number and make more sense out of it. When I'm saying IRR, for those of you who aren't aware, it's just kind of the discount, the discounted cash flow rate, or the other way to look at it is, hey, what's the compound rate that I would need over the hold period to hit, this kind of return? And then do you want to touch on?
I mean, it's basically the same thing there, right? But now looking at amortization. So let's say a bank offers you 25-year term versus a 30-year term. And you're kind of in that similar position, right? If you want to hit this certain IRR, you need to bring in that much more. You either take the lower return, like Fernando said, or you have to offer a much lower price than somebody else is going to. So again, you'll kind of lose out on that deal.
Yeah. And then, in Denver, whenever you're looking at value add deals, you're probably going to look at some sort of refinance. You need to double check that DSCR on your refi again, because if you don't hit that DSCR, you're not going to get the loan proceeds you were expecting, right? Unless cap rates just came crashing down or something. But yeah, just wanted to point that out.
Yeah, we have seen a lot of people forget to check that DSCR when they're putting in their refinance assumptions.
Yeah. All right. So we think this one's going to be really important kind of on the next part of the market cycle. No one really knows where we are. Since I've joined multifamily, we've seen all sorts of guesses as to when the top of the cycle is, and it just keeps getting, inflated or pushed around. That, it's there's an entire conversation that can go around that. But when you look at expenses, if you work with a good PM company, they're going to be pretty good. But you still have to, as an asset manager, control your expenses on the property, question what they're doing. Not every single dime, but definitely the big items. So just kind of looking at, hey, if you're running at 4,500 per unit versus 4,800, so $250 delta. Again, that drops your IRR a bit as well. So then that would be $54,000 swing in valuation. So the tighter you feel comfortable. Let me take a step back. I love betting on my team, right? Because I vetted them out. I've been working with these people. I've been growing with these people, and I'm willing to bet on them versus just bet on a cap rate or just bet on a market, right? So I'm not the kind of person that really wants to put in a 5 or 7% rent growth, but I will bet that I've got the best property manager in town that will hit the highest rents we can get that we feel are reasonable, while keeping our expenses at a very low reasonable number while maintaining a proper asset. And so I think that's just so imperative that, if you're an asset manager, if you're doing a capital expenditure that you're repairing on a property, you put that below the line, not above the line, right? If you put it above the line, it's going to help your current year taxes because it's going to be an immediate write-off. But when you're going to go refinance or sell that property, if you moved $1,000 even down to above the NOI instead of below the NOI, because you treat it as OPEX versus CAPEX, you just lost $20,000 of asset valuation there, which is huge when you're trying to either get some additional debt service or when you're selling a property. So
Some questions.
yeah. So with Nico, do we put a loan contingency in on our offer? That's been depending in Denver. We will put certain contingencies in place. In some of the other markets, we absolutely have a financing contingency. We have a partner that has a strong balance sheet, and so we feel more comfortable that we know what the market is really trading at, the debt that we can get on our properties, and the fact that we can bridge if required. So, cool. And then in the OPEX numbers, do you factor in turnover costs and replacement reserves? This can materially increase the OPEX ratio. Yes, Ankit, that's a great question. And we don't have it up on this slide here, but we really do. The R&M, we have. It depends on the specific market, but most of our units are going to be operating between 650 and 850. So, without doing a deep dive into it, it's about 750. But because we have so many buildings that are from the 1920s and 1940s, we expect that we're going to have a significant CapEx amount in there as well. So below the line, even beyond just the reserves that our lenders will require, we'll be putting an additional $350 per unit per year in for just additional oddball repairs that are once in a lifetime kind of things, or once in the ownership cycle. So, and yeah, it will, not only will it materially increase the OPEX ratio, but again, when we're talking about that asset manager statement there, that makes a huge difference when you're going to go get a valuation on your property, either on sale or refi there. So.
Yeah, and then the last piece being, the impact of income on value, right? So we looked at the Rentometer average rent per unit at $1,200 versus a local PM company at $1,400, right? And then based on the underwriting template, using some of the numbers that we've already highlighted, you're looking at either an IRR at a purchase price of 2.6. So if you hear from a broker, they're saying the whisper price is 2.6 million. Well, if you're underwriting at the Rentometer average, you're going to get a 4.04% IRR versus somebody else that's more familiar, trusts their PM company, knows that the PM company is achieving those rents in that specific part of town. You're looking at a 15.5% IRR, right? And so you can hit that price versus somebody else that can't. The inverse of that, though, and that's what I meant earlier by being careful with with looking at certain rent projections, right? Maybe you're not as familiar with the local PM company, or maybe you pull that number out from some Zillow listing, but it's just been listed at 1425 in your market, but nobody's actually achieved it, and you just didn't know. Well, in that case, you can see how, you know, you could have underwritten this property, got to that purchase price, promised your investors 15.5% IRR, but you aren't able to achieve it, you know, because your market is actually at 1200. So again, it's just all about knowing your market and knowing the PM companies that are like knowing that they're actually achieving those rents.
So Angel and Jake. So Jake, how do you determine what your reserves are going to be? You know, in general, beyond what a bank will require, typically what we'll have is a full year of insurance, 4 to 6 months of taxes, and then depending on the building, we'll have 1.5 to 3 months of total expenditure cash flow. So if it's, you know, a really stable asset, it will be down in the 1 to 1.5 months of cash flow there. If it's a less stable asset, we'll be in 3 months. If it's a really heavy lift, we may have to have an additional full year of cash flow to be able to handle, you know, if we're going to completely rip off the Band-Aid on a building, kick everybody out and do a real heavy lift there. So it is, you know, case by case specific.
And then what's included in OpEx?
Yeah, so, you know, again, that's we're fairly familiar with this because, you know, oil and gas, so you have to work a lot with your accountants there for what's an operating expense versus a capital expenditure. If you're ever confused or you're not certain, it's always worthwhile to talk to an accountant to give you, you know, a solid item of one versus the other. If you have something that's already there and you're just doing a repair of it, then that's just an operating expense, right? To maintain something, that's a repair and maintenance. But if you're making a capital improvement to the property, for example, you're retiring the old cast iron piping that's in the building and you're replacing it with ABS plastic drainage, that would be a capital improvement that you're making to the property. If you're remediating your asbestos, that's a capital improvement that you're making to the property.
A roof.
Yeah. Just a new AC unit because you're removing the old AC unit and putting a new AC unit in.
Water heaters.
Mm-hmm. So just it's important. A lot of sellers, you know, are pretty sharp depending on what market you're in, and they'll move stuff below the line just so you don't see it, and that way it doesn't hit the NOI, right? But it's always good to you know, if it's a sophisticated seller, ask them for, hey, do you have a list of capital improvements that have been made on the property in the last, you know, 3 years? All right. I think we're running out of time, so we're really gonna go very quickly through these last few slides. Scope of work, I think, is an important one. When we started underwriting, we heard everyone say, hey, out here in Georgia or South Carolina, we're renovating our units for $4,500 a unit. Well, what we found is in Denver, that's closer to $12,000 a unit. Because here in Denver, instead of, you know, just painting cabinets or some, you're likely refacing a bunch of cabinets, you're redoing a lot of flooring, you're installing a more luxury style finish. And so, you know, over time, we've kind of just started building out our, okay, how many labor hours does it typically take? We know what the rates are going for. We know roughly, you know, what kind of lighting package, what kind of hardware are we putting on there, all of the touch points and everything, if we're doing trim and everything. And so we've just broken it down. This is just a screenshot of a small portion of our sheet here. But, you know, again, when you're trying to get competitive and really sharpen the pencil, the more work you do here, the more comfortable you feel putting in those higher offers and starting to win these deals. So. And then this is just from CoStar. You know, this is all of Denver, so it's not a submarket of Denver. You can see that the US versus the Denver 3, the average Denver and the Denver 4 5-star. So, you know, A-class buildings are trading nowadays in the high 3, low 4 cap rates. Whereas, an older asset is going to be at about a 4.5 to a 4.9 cap, depending on what part of Denver you're at. You're in a crummy part of Denver, you can actually find 6.5 cap markets, but
Deals,
deals, but not places we choose to operate in. We really like the core plus locations in Denver.
And then, the forecast is flat because nobody wants to make predictions anymore. I think most people threw in their towel.
But yeah, as you build out your relationship with your brokers, with your property managers, ask them for these CoStar reports. They are invaluable because, this is just some of it, but they actually have detailed sales data. You can see what the price per unit has been in your market, because you may be going, how the hell is anyone paying, $220 a unit? Well, people have been paying $220 a unit in Denver for 4 years now, right? So it's just one of those things. And it's just a whole different beast. So.
Yeah. And then, any additional questions, we'd love to answer them now. Otherwise, you can always reach out via email, and then that's our Calendly link if anybody wants to set up a call. We'd love to connect and chat more and help answer any questions.
Okay, great. Thank you very much, Anna and Fernando. That was great. A lot of golden nuggets. If you have any questions, you can unmute yourself and ask Anna and Fernando. You don't have to type. Don't be shy.
Yeah, I have a question.
Go for it, John.
So if the market is to adjust, what would be the first thing to move? Would it be rents lowering or removing some of the ancillary charges as far as rubs, pet rent, and so on? How do you negotiate that?
Yeah, so that, it's a great question, and something that we actually saw here in Denver. So when prices started coming down during COVID, what sellers first did in bulk, right? And we're just kind of talking in bulk here. All of the ancillary fees stayed on, and people started providing concessions. So that's the first thing that starts going, is people start giving, 1, 2, 3 months. What we found is a lot of the concessions weren't really being given in the B and C class space, but a ton in the A class, especially during the lease up. But the second thing that we started seeing is sellers started signing people on at slightly reduced rates, 2 to 5% lower for 24-month leases, because they didn't know what the heck was going to happen here in the next year to 2 years with COVID. So that's the market response that we actually saw. Your guess is as good as mine in terms of a crystal ball, but if you put yourself in the shoes of a resident or tenant, what's going to motivate me, right? Hey, drop my monthly payment, right? So
I think it went both ways. So you had some people that, like Fernando said, dropped the rent and then signed people on longer leases. And then we've also seen some people that just went month to month with all of their residents, but still dropped the prices because they weren't sure if there's going to be like the eviction moratorium, how it's going to affect them. They didn't want people on leases so they could utilize that. You no longer have a lease, you're not paying, so we're just not renewing. We're evicting you for non-renewal rather than evicting you for non-payment.
Yeah, it's called a holdover lease.
Thank you. Anyone else?
Hi Anna and Fernando, what's the usual percentage of property management fee that you pay, and any resistance so far or any problem with Rhino implementing Rhino insurance for the security deposit?
Yeah, so every market we're in, we pay a different property management fee. In Denver, it tends to not be clear cut. You can find some PMs that will just throw a 10% number at you, an 8% number at you. We've seen even as low as about 7% of collected incomes. But the PMs that we have really enjoyed working with here in Denver, they charge us 5% flat, and then they have a bunch of ancillary fees depending on how many hours their asset managers, their property managers, and their leasing staff and advertising staff are using. All in, with our assumptions plus what we've actually seen, it ends up being about 8.3%. We can find cheaper property managers, but we choose to stick with these guys. They do an incredible job advertising, staying on top, and providing a phenomenal customer experience. And we find that goes a really long way in these competitive markets.
Yeah, and then as far as Rhino goes, it's all about education, right? First your property manager has to get educated on how to present this new product to the residents, and then the residents, then they have to educate the residents to understand what it really is. And then there's the whole adoption to your market. So, in Denver, our property manager doesn't have an issue with Rhino at all, because it's something that they've been working with for a while now, and now most people are familiar, and there's other property managers who are utilizing it. In our Greensboro, North Carolina property, our property manager is the first one in the market. We introduced them to Rhino. We asked them to implement it on their property, and they're just starting. So they just kicked it off last month, and we only just now got our first vacant unit. So they're starting to advertise it, but it's going to be slow. They're starting out with our property being the very first one in that market. So it's going to take some time for them to, it took them a while to have the coaching calls with Rhino. And there's other programs aside from Rhino. There's surety bonds. There's a couple of different companies that do this, but it's a learning curve for everybody.
And South Dakota, we've been working with our PM there for 2.5 months, and they don't understand the value proposition of it. So they don't really want to bring it on themselves. So we're actually getting more headwind from our PM than we think we would get from the market. So,
Thank you.
yeah.
Thank you. Anyone else? Going once. Nice. All right. Thank you everyone for joining tonight. We learned a ton of good stuff today from Anna and Fernando. Anna and Fernando, thank you very much for coming and dropping the golden nuggets. We all appreciate that.
Thank you. Thank you guys as well. And thank you all for joining. And thank you to a lot of faces we see on here that have been, coming to the underwriting pod. We've learned all of this information thanks to you all for joining in, calling in. It's all like a learning progress and multifamily team sport. So we really appreciate you all.
All right. Thank you. Thank you, everyone.
Hi, guys.
Tune
Thank you.
next one.
You know,